This week, we're trying to make sense of all the signals the global economy is sending us. We're going to look at why some companies are absolutely flying, while others are, well, a little more cautious. We'll also dive into how central banks are walking this incredibly fine line with inflation, and what a huge new trade deal could mean for all of us. So, yeah, let's get right into it. And to kick things off, this quote from AMP's chief economist, Dr. Shane Oliver, really just nails the feeling right now. The whole landscape is defined by unpredictability. You've got policy decisions and global tensions that are creating some serious waves for investors and businesses alike.
And that really is the billion-dollar question, isn't it? How do we separate what's actually important from all the background noise? We're going to break down the key data points from this past week to try and give you a much clearer picture of the financial world we're all living in.
Okay, first up, let's take the pulse of the market. What's the mood on trading floors from New York all the way to Shanghai? Right now, it's a really tense mix of fear and, believe it or not, some cautious optimism. We're seeing this real tug of war between different forces. Geopolitical fears are pushing investors towards safer assets, while the constant threat of tariffs keeps entire sectors on edge. And when you add a jumpy US dollar and some pretty mixed company reports to that, you get a perfect storm of uncertainty. And here's the thing, this uncertainty isn't hitting everyone the same way. Over in the US, some strong company earnings actually helped stocks squeak out a small gain, and Chinese shares also went up. But then you look at the Eurozone, and it's a totally different story. Stocks fell. It just goes to show you how much regional issues are playing a major role right now. So, let's zoom in a bit. Let's go from that big picture market view right down to the health of individual companies. It is earnings season, which is basically a quarterly report card for the economy's heaviest hitters. And honestly, it's giving us some really fascinating and conflicting signals. So take a look at Disney. Most analysts are pretty optimistic, right? But then you have Bank of America, and they're pumping the brakes a little. They're worried about a potential slowdown with international theme park visitors and some so-so box office results. That's why their forecast is just a bit lower than what everyone else is thinking.
But then you have a company like Alphabet, Google's parent company. And the story here could not be more different. Wall Street is expecting absolutely spectacular growth compared to last year, both in earnings and revenue. This is all being driven by huge momentum in their core businesses, Search, YouTube, and their fast-growing cloud division. It's a massive signal of strength in the tech world. And it's not just tech versus entertainment. This week is giving us a snapshot of the entire economy. We're getting data from healthcare giants like Pfizer, consumer staples like PepsiCo, and financial tech like PayPal. Every single one of these reports is like a piece of a puzzle, telling us whether people are spending on must-haves or nice-to-haves, and really, just how healthy businesses are. Now, this mix of strong and weak performance from companies feeds right into our next big topic, the global fight against inflation. We're going to use Australia as a case study here because they are facing the same kind of high-stakes decisions that central banks all over the world are dealing with. Okay, before we get into the numbers, it is super important to understand this term, trimmed mean inflation. Sounds kind of technical, right? But basically, central banks love this number because it strips out the really volatile price changes, like a sudden spike in gas prices, so they can see the true underlying trend. It helps them avoid overreacting to what might just be a temporary blip. And here it is. This is the number that's causing all the drama down under. Australia's annual inflation is running at 3.8%. Now, for the Reserve Bank of Australia, whose target is between 2 and 3%, well, this is a major, major red flag. So this puts the central bank in an unbelievably tough spot. I mean, look at this. On one side, you have high inflation and a strong job market, which screams that they need to raise interest rates to cool things down. But on the other side, there are signs that inflation is already starting to slow, and another hike could really crush consumer spending. It is a true economic balancing act. Okay, so while central banks are wrestling with all these immediate problems, there are these massive long-term shifts happening in the background. We're going to pull the lens way, way back out to see how a huge new trade deal between India and the European Union is getting ready to reshape global commerce. To really get a sense of the sheer scale of what we're talking about, just look at this number. Over $136 billion in goods already moved between these two partners last year alone. This new free trade agreement is all about making that relationship even bigger and creating an incredibly powerful economic bloc. So here's what the EU is putting on the table. It is a really ambitious move. They've promised to immediately get rid of tariffs on over 70% of goods coming from India. I mean, that gives Indian exporters a huge, instant competitive advantage in one of the world's biggest markets. Now, India's approach is a bit more cautious. They're offering immediate duty-free access on about half of the items, with more being phased out over time. This shows a more balanced strategy, right? They're opening up their markets, but also protecting sensitive domestic sectors, like agriculture, from a sudden flood of competition. So we looked at jumpy markets, mixed company earnings, a super tricky inflation fight, and a new global trade map taking shape. But how does any of this actually connect back to your life? Let's break down the real-world impact. That market volatility we talked about, that's not just a headline on the news. When geopolitical fears cause a dip, that directly hits the value of your 401k or your other investments. Understanding these global risks really helps explain the ups and downs you see on your own financial statements. And those corporate report cards are so much more than just numbers for Wall Street. When a powerhouse like Alphabet is hiring and expanding, that signals a lot of confidence in the future. But when a consumer giant like PepsiCo reports slowing sales, that might be an early warning that our household budgets are getting tighter, which can have ripple effects on jobs and the whole economy. That high-stakes battle against inflation, it's happening right inside your wallet. The decision the RBA has to make in Australia is the perfect example. If they raise rates to fight that 3.8% inflation, it means mortgages, car loans, and credit card debt get more expensive for millions of people, almost overnight. And finally, that huge India-EU trade deal, it will eventually show up right in your shopping cart. It could mean lower prices for things like European cars or Indian textiles as those tariffs disappear. It also reshuffles supply chains, which could make some things more available while creating a ton of new competition for local industries. Which kind of leaves us here. We see this incredible corporate strength on one hand and exciting new partnerships forming on the other. But at the exact same time, you've got this stubborn inflation and geopolitical risk creating constant tension. So, is the global economy more resilient than we give it credit for, or is it balanced precariously on a knife's edge? That's the key question to think about as these stories keep developing.